And today we have a special webinar for you with our guest, Maggie Gomez of moneywithmaggie.com. Hey, Maggie.
Hi, thanks for having me.
Yeah. Well, Maggie, you're a certified financial planner who is on a mission to help you feel strong. Well, help all of us feel strong and confident in our financial decisions. I'm just going to give everybody a little bit of information about you because Money at Maggie, there's no intimidating financial professionals or unattainable minimum investment requirement, just real life expertise and an expert in your corner to help you learn and succeed with money. And today we're going to be talking about 3 tips to save money on our taxes. Okay. And it's really hard to believe that it's almost 2023. It's really just right around the corner, and tax time will be here before we know it. As the saying goes, there are 2 things we cannot evade, and that's death and taxes. And at Modern Widows Club, our ladies have faced the death of their partner or spouse. And that means that they do have some tax implications on top of that. And while no one looks forward to paying taxes, it's a part of life. And you may be wondering if there are ways that you can save money on your taxes, because there are many strategies to help reduce your taxable income. And you still have time before the end of the year to make changes that can reduce next year's tax bill. So today, Maggie's going to share 3 tips to save money on taxes. And you may need to itemize rather than take a standard deduction in order to use these strategies, but the extra effort will be worth it. So you may want to speak with your tax advisor to see which of these tips that she's going to share with us may be right for you after this webinar. So get some pen and paper out, because I think you're going to want to take some notes. So let's start with the first one, Maggie. Tell us about the first tip that you have.
All right, so we'll talk about charitable giving, because this is a really, really great way to both satisfy your wanting to give and support charities that you love. Modern Widows Club, hopefully, if you're watching this, like, it's an excellent organization. But so if you're already planning to give to charities, you can use that to reduce your taxable income. So you're not going to it's not dollar for dollar, right? But it reduces how much income tax you pay. And it is a really great way to just do both, satisfy the giving and also reduce your taxes. There's a couple ways you could do this. So we'll talk about those. Let's first talk about the itemized deduction part, because what I learned, like a strategy that I learned, was that you can't, and I'm not a tax advisor, so I am a certified financial planner, which is like the gold standard in planning, but like Carolyn said, like, talk to your tax advisor. So the things that I'm bringing up, I know at a high level, right? I don't know the nitty gritty. But what I learned was you can, if like, let's say you aren't someone that itemizes deductions, but maybe you could get close. What you could do, a strategy that you could do is, let's say you were planning to give $10,000 every year. So instead of doing it this year and next year, if you have the ability, you could do both things. Like, so instead of doing 10,000 this year and next year, you could do 20,000 this year and none next year. But what that would allow you to do is use your itemized deductions, because that might bump you up over the standard deduction. And then next year you would get even more, because you would have a higher standard deduction, or you would have that standard deduction, but then this year you would have the itemized deduction. So especially since we're so close towards the end of the year, if you were like, well, I'm going to give this year and next year, think about how much you're planning to give, and maybe that could bump you into the itemized deductions and save you some more and allow you to take advantage of that. So that's one thing. Now, let's talk about you can donate from your retirement account. So
yes.
once you're 70 and a half, you have to take required minimum distributions every year. But let's say you're at a point where you don't need that extra money. You're not going to use it. Maybe it's just going to sit in your bank and you just aren't using it anyways. Why not give that to an organization that you care about? And it satisfies the RMD, so you don't have to pay tax. Because when you pull money out of a retirement account, what happens is that increases your taxable income for the year. If it's in a traditional IRA, a traditional 401k, that money increases your taxable income and you pay tax on that for the year. If instead you send that money directly to the charity, you don't increase your taxable income. So remember, if you're using the strategy, you wouldn't take the money and then give it to the organization. You have to do it directly from your IRA to the organization in order for it to qualify for that.
Yes, and we actually have a donor advised fund at MWC, so it can actually transfer account to account. Yes.
Oh, perfect. Yeah. So that makes it really easy. And if it gets confusing with the logistics, you can just call your investment firm and they usually have a tax line that can help you with that process. So it is pretty simple, even if it seems more overwhelming and complicating. Remember that at these investment firms, and I've worked for several of them, they have so many different helplines. And you just, it's a matter of picking up the phone and asking like, hey, do you have a tax line? Do you have, they have RMD specialists there at the end of the year. So there's a lot of resources if you just pick up the phone and talk to them, but also keep in mind,
I would think at the end of the year, this is, if you have a financial planner, this is a conversation you're going to have at the end of the year between the two of you, especially depending on what age you are, and of course what's in your portfolio, and if you're a traditional giver, you know, or maybe you're a new giver, and you need to have that conversation.
And sometimes financial advisors, if they don't have the capacity, they're not going to reach out to you and say, hey, it's time for you to do your RMD. And guess what? If you forget to do your RMD, it's a 50% tax penalty. Whatever you were supposed to take out, you have to pay 50% taxes. So you do not want to forget taking your RMD if you're at that point. So that's a little bit on like the giving from an IRA once you're 70 and a half. Obviously, not everyone's going to fit into that bucket. It's reached that point in your life.
Talk to people who are younger, like me.
And one that is you have $100,000 limit that you're able to. So it's really high. You're able to give a lot without having to pay tax on it. So that's
actually really Maggie, we're now a public charity. So because we're considered a public charity, you can actually give at a higher rate of untaxed income, which I didn't realize that. I had to actually look it up. We're not just a 501c3, we're a 509A2, which means that, so we actually at Modern Widows Club have now been classified as a public charity and have proven that the support for our organization is truly public.
Okay, amazing. Yeah, so that's where you would really want to work with your tax advisor and make sure you're, taking advantage of it. And especially if you're, if you like, when I worked at these brokerage firms with clients that had built these portfolios, a lot of times you get into the habit of spending what you've always spent and your money. And this is a really good problem to have, but your money's just grown for you in the background and maybe you just don't really need it. So that's where you really want to start thinking like, hey, am I going to pass away with this large lump sum of money, or am I going to start putting it to work so charities can benefit from it right now? Obviously, you can give at your passing as well, but this is a way for you to start giving prior to that and seeing the benefits of your gifts too.
We actually just had a few people actually make Modern Widows Club their beneficiary. It certainly is on my life insurance policy, and of course my planned giving for the organization. But you're right. You have to think about now, and of course also when you pass away, where would I like that to go? I mean, at Modern Widows Club right now, every dollar equates to one widow receiving direct service. And so this year we have delivered over 200,000 direct services. We have never been at the capacity we're at now. It's about 30,000 direct services being provided to widows every month. And Maggie, having grown up with a widowed mom, and not really not knowing anything about money, the value of what a donation can mean. And then there's that tax benefit for you on the other side. Yeah. Mm-hmm.
Yeah, keeping that in mind, like the organizations that really, like, if this was around when my dad passed away, I feel like it would have been good for my mom. So beneficial for her to be plugged into a community, and she wouldn't have known, like, she just doesn't know how to manage money because she just didn't grow up with it, right? But so giving those resources and support to people on both ends of the spectrum, whether you've got lots to work with or you're just kind of scraping by. I know widows are in a huge range of positions from when their husbands passed, right? Some have life insurance, some have no life insurance, and are just like trying to figure everything out all over again.
That's right. So we have the first one, and are we on number 2 now?
Let me see. Okay, so really quick with the charitable distributions, you can give up to 60%, but I think, like you said, with your organization, you might want to talk with your tax advisor, but just the overall point is keep in mind charitable giving as a way to reduce your taxable income. So yeah, that's number 1. And number 2 is, what was number 2 again?
Contributing to the retirement account.
Yes.
Was what we had talked about.
Yeah. That I see people not realizing with a 401k, a lot of employers offer a match. Some employers do not offer a match. And often I see people say, well, my employer doesn't offer a match, so I'm not going to put money in the 401k. The other benefit besides that free money of your employer doing a match is you reduce your taxable income dollar for dollar when you put money in a 401k. So it's a huge benefit to get money into those tax deferred accounts so that you tax on it. With the 401k, that's like $18,500, something like that. So that allows you to put much more than you could in an IRA, which that limit is $6,000 per year if you're under 50, and if you're over 50, it's $7,000 per year. So that means if, let's say, you make $50,000 a year, if you put in $6,000, your taxable income just based on that goes down to $44,000. So you save yourself $6,000, or you reduce your taxable income by $6,000.
We like that. Yes.
Yes. Yeah, and that money just goes tax deferred for you. So it's a great thing to think about, even if you've got money in your bank account, if you've got money in your brokerage account that you could just move into a retirement account. Consider that, because that will really be a way that you can save money on your taxable income.
My advisor definitely encourages me. In fact, part of our planning is to get to that dollar amount every year, because she'll be like, okay, this is what we have to do each month in order to meet that. I'm under 60, so mine is $6,000. But then I guess next year when I turn 60, I'll be able to bump it up to 7, which I'm sure she'll tell me that. So now I know.
Yes, it's actually 50 if you're under 50. So you might be able to do
under 50. So I actually am doing 7,000 now. Okay, perfect.
Okay. Yeah. So keep that in mind, like the extra that you could do.
We got the charitable giving, and then we have the contributing to the retirement accounts, which is excellent. And then we have the tax loss harvesting. What is that?
Yes. So and this is going to be something that can probably easily be taken advantage of this year, with this year having such a negative impact in the stock market. Stocks are down, so you might have some losses. So what tax loss harvesting is when you sell your stocks, whether it's to take money out and live on it, or you sell something, buy something else, there's what's called capital gain tax. If you've owned the stock for more than 1 year, you pay capital gain tax. It's either 0 if you make less than about 40,000, it's 15% if you make 40,000 to like 400,000, and then it's 20% if you make more than that. So most people are going to fall in that 15% bracket. So that means if for every $1,000 gain that you have, you pay $150 in tax. If you, let's say you're taking money from your investment portfolio, whether to live on, and over the course of the year, you've taken out a good chunk. What you want to look at now, because you're going to have to pay capital gain tax on it, most likely. So what you want to do is look at your portfolio and see if you have any losses that you could sell and use those to offset the gains. So if you sell a loss, that means like a stock has dropped. So for us, we did this in 2020 when the airlines had just tanked. I still think the airlines are just like doing so bad. But we had a good chunk of money in airline stocks because my husband travels so much. And I really believe in investing in companies that you use all the time. So we had we were just down significantly from the airline stocks. At that same year, we also used our investment portfolio to put the down payment on our house. So we had about $50,000 that we had pulled out of our investment accounts. So there was gains on those. So what we did at the end of the year was I went through and I looked, okay, what stocks are down? This may be in 2021, I can't remember, but we looked at what stocks were down and then sold as much as we could to offset the gains. So it really reduced a lot of our taxable obligations from those stocks. Now, the problem with selling when stocks are down is then you don't benefit if they rebound really quickly. Right. So what you want to do is think about like buying, well, you can buy the same stock back 30 days later or 31 days later. So it's one of those things like consider if you think it's going to be down for a while, you just sell it and rebuy it if you want to invest in that same thing still. Or it's also a great time to rebalance your portfolio. So often every year there's a certain type of investment that will do better than other types. So whether it's technology, if you've had some technology stocks that have really grown for you and they have massively lost this year, but let's just use that as an example. If you have tech stocks that have a large growth, and we still have a lot of capital gains in our tech stocks because we've owned them for 6-7 years. And if we sell, we still have to pay capital gain tax. But if you've gotten to the point where maybe your portfolio becomes imbalanced, like if you think of a pie and like your tech stocks are one slice of the pie, as they grow, that slice gets bigger and bigger, which puts you at more risk for years like this. So if you trim off some of that growth and reinvest it into other areas that haven't done as well, that will allow you to minimize your risk exposure because you don't want to have too much in one area. And it'll also, during that time, you can say, okay, we sold some of these, we're going to buy in other areas that have maybe shrunk in that pie. And that will allow you, when you do that, you can also look for losses and then use to offset the gains. So keep that in mind.
Well, and doing that, like it's, some people are their own investors. Some rely on financial investors, but is there some place that those that are listening here can go to determine what those stocks are going to be, or what those investments are going to be? Where would you recommend that they go and do the watch?
So when you go into your investment portfolio, you will see, you can look for realized gains, and there's a section, there should be a section somewhere in your account. And if you can't find, just call your firm. Like, do not feel hesitant to call your investment firm. And there will be a section that shows realized gains. What realized gains means is that's what you have sold, and it's the gain. So that amount is what you want to say, okay, that's what I'm going to have to pay tax on. Now I need to go sell some losses. So then you go through and see which stocks are down, if any.
And is this the time of the year to do that? I mean, is this what, we're only 3 weeks away to the end of the year? I don't want to slam all of the financial advisors.
Financial advisors are prepared for it. But you might have to be proactive with calling and asking for these services, asking for it. But they have people working overtime. At least when I was working at the firms, that's how it is. Like, they just know it's coming.
So they know they're going to get an influx of questions like this. It's just who's going to ask the questions, right? And I would assume that once you learn these tax advantages, right, and making those decisions now versus once we're into a new calendar year, you kind of, that's your calendar of sort of awakening every year. Year now you start looking at this time of the year. And as far as year-end giving, we do get year-end giving from really from our donor base and from all of our supporters. And I think it is those people who are doing exactly what you're saying, is they're looking at ways to reduce that tax implication for next year by making smarter decisions now. So is there anything else that you want everyone to know in kind of closing here? And what else? Those were your 3 tips, which are awesome. I would say when I get off the phone.
You what?
I have to call my advisor when I get off the phone.
Yeah. Keep in mind, so what I do is every year I dedicate a day and I like to do it right after Christmas. So it is kind of in that last minute zone, but that's just how I do it. You could do it, early in December, but I like to say once a year, I'm going to review my portfolio. I do this every single year. And it allows you the rest of the year, like, mentally away from your investment portfolio, because you just don't have to worry about it. I put in the time to review, and this is a great time to review what you're invested in, to recommit to your investments, or say, you know what, I think I'm going to make some changes, reduce my risk, or just any changes you want to make. It's a great time to both see how you're invested, see the changes that you need to make the decisions on charitable giving if you have the capacity to do so. If you're in a fortunate position of having some excess money and you want to help gift other communities and charities and organizations, Modern Widows Club, AKA, then do it, because it's just such a great time and to benefit from these laws that are there for us to reduce your taxable income. So
that's right.
And
at Modern Widows Club, we really want our community to be educated, right? I mean, I feel like you have more knowledge, you have more confidence in making your financial decisions and that impact so many other areas. I know that being smart about your money, for me, equates to, can I go on a vacation later, right? Because I've given, I've saved, I've invested well, and now I've rewarded myself. And I feel like that's very empowering for our community. And I really appreciate your advice, because it's not just professional, it's also personal. Having had a mother who did not have any of this knowledge or really ability to make these decisions. And, that matters, because there is an art to a woman's life, certainly. And the quicker we learn this and invest and are able to be smart about our money, I think
Yeah.
the more economic stability we're all going to have.
Yeah.
Yeah.
Yeah. And just taking some time, even if it's intimidating, even if you're overwhelmed, even if it's the last thing on earth you want to do, let's start looking, start saying, like, what do I own? A lot of people, not just widows, a lot of people across the board I've
Yes.
seen do not know and understand what they currently own in their 401k. Somehow somebody told them to buy something. They don't really understand it. So just taking a look and saying, what is this? And just a simple plug the fund into Google and take a look, see what the fees are.
And just taking ownership and taking back your power. That's really what this is very much about. So thank you so much, Maggie. I so appreciate you spending some time with Modern Widows Club community and everyone who's watching this live on all of our channels. And happy holidays to you and happy third motherhood to you. I know there's a lot going on in your life and you're busy, and I really appreciate always everything you have and the expertise you have and the heart and the giving that you do with Modern Widows Club. I really appreciate it.
Yeah, thank you so much for having me. Thank you for everything you're doing in the community as well. So I really appreciate your contribution to the world.
Thank you. Well, thanks, everyone, and thanks for being on our webinar. I hope you enjoyed 3 tips on saving money on your taxes this year and next year.
Bye.